our platform, that is 915trade.com. So for everyone's benefit, what I will do is I'll try to explain what this platform is, how does it operate, what do we do, how does it work, and give some basic idea about different things that are available in the platform. While we discuss about the platform, I'll also explain some of the strategies, and I'll reveal as to why this platform is good and why our subscribers love the platform and why it is one of its kind, and both as option buyer and a seller, why this should be a must tool for anybody who is trading in options. So let me start with basics of the platform itself. 915trade.com is our platform, and the whole idea is we wanted to analyze the market movements based on volume. That was the base premise, saying we want to give priority to volume. We want to understand everything through volume and not price at all. So when I show you the platform, you will realize that we discuss very little about price. We don't say price action, candle patterns, nothing. We don't say anything. We don't do a lot of price-based indicators either. What we try to do is we try to analyze data based on volume, purely based on volume. And that is where we shine, and that is where we are different. Now let me explain to you, what this is. So you have got options of either live data or historical data. I'll go to live data and I'll just go to Nifty. So this is Nifty. You will have 4 different charts in the main dashboard of Nifty. In the main dashboard, you only get 4 options, but now we have got more options for you to see data in different views. Again, like I said, right, understand that our idea is to be able to understand volume better, more than anything else. We purely want to understand volume. Then what do we do? How do we understand volume better? Now, before I explain these 4 charts, you all know that for Nifty to move, there are only 2 things that can move Nifty. There are only 2 places where you can invest money to move Nifty: Nifty futures and Nifty options. Spot you cannot buy. Unlike equities, you cannot buy spot. So only futures and options, there are only 2 places where you can invest. So volumes will show up either in futures or in options. So if we can understand those 2 volumes, predominantly we understand everything about Nifty. Then let's look at the volumes of those 2 and see if it can make sense for us to see whether we can take effective trades based on that volume or not. Is the futures volume. What we do here is we try to show you the futures volume as both buyer and seller volume, 2 separate things. How many buy contracts are executed versus how many sell side contract, buy side and sell side contracts are executed. That we segregate it and we show it to you every single minute. Now understand that whatever data we show you in the platform, it is all 1 minute. We don't have any other time frame. I'll explain to you why we don't have any other time frame also, but everything is 1 minute. So we show you buyer and seller data, how buyer and seller are interacting within futures. We show it to you as 2 separate different lines. If buyers are growing continuously and if sellers are a little bit of weak, it means that there is a lot of buy power. If sellers are growing significantly, that means there's probably some sell power. For example, here there is probably some sell power. It will be difficult to understand just by looking at these 2 where the buy power and sell power is, which is why we have a difference chart, which is nothing but buy minus sell. Morning there was a little bit of sell pressure, but it did not sustain it. It could not push it below this, and then it started going up and it went up, and then it continuously started falling, and obviously the sell pressure sustained towards the second half. It won't mimic it like you see the price, but in general, the way future price is moving, that will sync with how the price is moving as well. Nifty. So it is important to see difference, because if you only see a buy and sell, you will not know when sellers are growing, when buyers are growing. It is difficult to understand that way unless you're used to seeing it on a daily basis. But if you see the difference line, it becomes a little easy to understand if buy pressure is increasing or sell pressure is increasing. Getting back to what I was explaining. So we have got the futures data, you have buyer and you have seller, and you have got the difference. Then I'll talk about this a little later. We then have spot candles. We only look at Nifty spot candles. Why we do spot candle? Because the ATM strike depends on where the spot is, not where the future price is. That is why we only look at Nifty spot price. These are 1 minute candles. Very simple. I will explain about this blue and pink markers in a little while, but these are all Nifty spot candles, 1 minute candles. And then these lines, but the horizontal lines that you see, they are all strike lines. That means this was a strike, 950, 600, sorry, 26,000, 2650, 26,100. At every strike, you will see a line. And this is the same thing you will see for Bank Nifty, Sensex and FinNifty as well. At each strike, you will see a line. The reason we draw these lines is we believe that the best buy positions, if you are doing by price, the best strategy is to always take positions from the strike. Understand whether buy pressure is strong or sell pressure is strong and go from strike to strike, because in sideways market, that helps you significantly. And that is why we have got the strike lines. It also helps to identify saying that, okay, Nifty probably went 50, 100 points today, right? It becomes easy to identify. That's why we have strike lines. The other thing we have is opening range high and opening range low. We have 2 things. We have a strategy based on opening range and low. If this is visible it is probably because in profile in settings, there is a configuration in the settings that says enable opening range. If you click on that, then this will automatically get drawn. We do opening range from 915 to 919, right? High and low of 915 to 919. We take, that is the first 5 minutes, we take the high and low and we draw the opening range. I will explain the strategy obviously in a while. And then we have got pink and blue markets. I will talk about it in a little while. We have futures data. We have got spot candles, strike lines and opening range. I believe it is easy for anybody to understand these two. We then have, by default, if you open for the first time, it will look like this. And then what I do is at the bottom right corner, I have got high and low. When I click on that, it becomes reverse. Okay, that is how I look at it. Most of the people now are used to looking at it like this. What is it? I will tell you. Yeah, so this is the strike wise volume wherein we show you ATM strike. We show you 5 strikes at the top and 5 strikes at the bottom. ATM strike plus 5 strikes and bottom 5 strikes. And we think that you don't need beyond this. You actually don't even need plus 5, minus 5. But then sometimes what happens is your biggest resistance is not around ATM strike. So we show you 5 plus 5 as a benefit. We show you plus 5 and minus 5. Now, when you do high and low at the bottom right corner, what it does is it shows the top strikes at the top and bottom strikes below the ATM. If you see NSE, right, the top strikes will be below ATM strike and bottom strikes will be above ATM strike. That's how NSE shows option chain. That's how we started it. But then it was becoming very confusing. So we switched it. That is why you have to use the high-low configuration to see top ATM strike and bottom 5 strikes. Now, what is this? We try to show you seller and buyer mindset is what we are trying to analyze. Whatever is in the red is kind of a seller. Whatever is in the blue is kind of a buyer. But then who is the buyer and seller in option? In reality, everybody is a seller, option seller here. For example, today, let's say 26,000. If all of you had taken 26,000 put buy, let's say thinking market will crash tomorrow and you have not sold the contract. You have taken 26,000 put buy. Your volume, your contract will not be shown, will not be part of this. It will not be shown. We ignore it completely. But assume that you had taken 26,000 put sell. That will definitely reflect here. We don't miss out any sell contracts. Then what is red? Reds are nothing but call sell contracts. Green is nothing but your put sell contracts. Call sell and put sell. Why we have green in put sell? Because when put sellers are really strong, market goes up. When call sellers are strong, market goes down. That is why we chose red and green for call and put. Whatever is red is call sellers. Whatever green is put sellers. Even this data is available every 1 minute. This is not open interest data. This is data that we calculate it on a daily basis based on the running volumes that we get from NSE. Okay, this is not open interest. This is based on the volume that we do some calculations. Because if you see open interest of 26,000 put in Kite or in TradingView, I am sure the open interest will be close to 80 lakhs, 90 lakhs and all that. 26,000 put. It will not be 19 lakhs. What we do is whatever volumes you see on the screen, every day we start volumes at 0. We start with 0 and then we start counting if puts are increasing, calls are increasing, etc. We don't count what happened yesterday. We completely ignore those volumes. Every day we start with fresh volumes and we only show that day's volumes. If put sellers are strong, you know that they are probably going to defend 26,000. It looks like tomorrow if the price comes back to 26,000, they will definitely defend it. Calls are not too confident whether they will defend 26,000. They are not confident at 26,150 either. 26,200 maybe, right? They are not overly confident at 26,200 either, but looks like 26,000 puts will definitely defend. Ideally, when something like this happens, I keep saying next day I wish price opens 26,000 or below 26,000 because it then presents a good call buying opportunities. So you have got futures volume, you have got spot candles, and you have got strike wise volumes as well. I hope these 3 things are clear. You then have something called as a trend line. Now this trend line is purely built based on volumes. It does not even look at price. It doesn't care what Nifty is doing, right? Nifty in terms of price, what it is doing. Whether it is going up or down, it doesn't even care. It basically draws everything purely based on volume. How is this drawn? So to understand this, let's say that we are all sitting in a market where there is a particular commodity. Let's say fish. Fish as a commodity is being sold in one shop and being bought in one other shop. Only 2 shops in the entire city. The sellers are queuing up in the sell shop and the buyers are in the buy shop. They are all queuing up. Now, what I tell you guys is all of you are in the market, but I tell you guys not to look at the shops. I will ask you to look the other side. Look opposite. Don't even look at the shops. I'll give you whiteboards and I tell you every minute the quantity of whether buy or sold. That is all I'll tell you every 1 minute. And then I will ask you to simply put the dots and draw the line. For example, in the morning at 9:15, I'll tell you saying that 70 kg is sold more compared to the buyers. So buyers have bought, sellers have sold. If I look at the net, 70 kg is sold more. What do? Below 0 at minus 70, you put a dot. And then I say at 916, I say that 20 kg is sold more. Then what you do? From minus 70 to minus 90, you will put another dot at minus 90 and you will draw a line. And then at 917, I say 30 kg is sold more. You will go to minus 1.2 or whatever it is. I keep telling you that they sold more, sold more, sold more. At one point I say that they bought more. Then what you do? You increase it. You keep going up. When I say sell, you go down. When I say buy, you go up. I tell you to do this for the entire market, whatever 6-7 hours market is open. I'm telling you saying they bought more, they sold more. You are only drawing the line based on how much they bought and how much they sold. As simple as that. You don't know what's happening with the price. End of the day, I ask all of you to turn around and look at price. I say, see what happened to the price of the fish. You all realize that the fish had exactly the same pattern as the line that you had drawn. The price of the fish literally had the same pattern of the line itself. You drew the line based on volume. I never told you price for the 7 hours. I only told you volume. You drew the lines based on volume, but the price also had the same pattern. Understand what kind of value these volumes bring and understand what is the significance of those volumes in that case. If price is following that volume, you can understand the significance of those volumes, right? How important those volumes are and how good, how accurate and how reliable these volumes are. This is purely drawn using that kind of volume. Okay, future and options put together it does, but it is purely drawn based on that volume. What you will realize is Nifty, if you go to historical data, which is completely free, you will realize that the trend line 100% mimics with the price. The price mimics the trend line. Although the trend line does not look at price at all, Nifty price 100% mimics the trend line. Whatever the trend line does, the price also does the same thing. We proudly say this every time, and I would like to say this now again, that there is not a single platform that has got a trend line based on volume. We are the only platform in the world, even on TradingView, I can't find a trend line that is drawn based on volume that is this accurate, right? So this is the only platform that is drawn purely based on volume, and the trend line, the price 100% follows the trend line. The reason why I'm stressing this is this should give you the confidence on the kind of data that we are looking at and the way we are looking at this data. Because if the trend line is this accurate, that means the data, underlying data that you are seeing obviously has to be very, very meaningful. And I am telling you that this data is nothing but the futures and options data. Based on that only this is being drawn. Now trend line also, there are two things here. The actual trend line is this guy, but because it has too much noise, we do a smoothed trend line, which is called as alpha arc. Anywhere in the platform, if you see alpha arc, it is nothing but a smoothed line. Understand that. So the smoothed version of trend line is nothing but alpha arc. What we have also done is when it is going up, we have given you different colors, blue and pink. If it's going down, it will be pink. If it's going up, it will be blue. Simple as that. Now we understood what is the futures data, trend line, Nifty spot candles, and also we have got strike wise volume. 4 things. Great. We understood the basics, but then that doesn't help you to take decisions, right? So to take decisions, you will need some more understanding of this or how you could basically use the platform. That is important. Let's understand a few more things and then I'll start explaining to you how you can take decisions. And today's data only, I'll tell you how you could have taken decisions today and yesterday. 2 very interesting data segments, I'll tell you. Before that, let's understand markers. What you see, this blue and pink, they are essentially called markers. They are telling you that there is an underlying buy pressure or underlying sell pressure. Wherever it is being drawn, they're essentially telling you saying that there is an underlying buy pressure or underlying sell pressure there. You can expand it by clicking on that. You will realize that the markers, if you see in the historical data, there is not a single trend you would get without the markers following it. That means if you have got an uptrend, markers will definitely appear before the trend starts and the trend will only continue along with the markers. Doesn't matter if it is going up, you will get blue markers. If it is going down, you will get pink markers. Not a single trend is missed out by these markers. However, these markers, they start, the triangle basically comes after a gap. If the dots are not there, then the next when it starts, it will only be a triangle. The triangle, just for easy understanding, whenever the triangle has to be shown, it needs, let's say, a confluence of 100%. It is 100% confident that there is a buy pressure. The dots appear even if there is a confluence of 70%. They say even 70% if they are confident that there is buy pressure, dots will appear. That is only difference between triangle and the dots. The confidence for the dots is slightly lesser than the confidence for the triangle. The other thing also you understand is because the triangles need 100% confidence, they never start at the bottom. It is not possible for these markers to appear before the trend starts. And that we are vocal about it and we tell you the way these are designed, only by chance you will get it somewhere at the top. They're always going to miss the bottom. They will, once the trend moves a little bit, only then you will get the confidence, because the triangle needs extremely high confidence. So you will only get it after the price moves a little bit, which is even good, right? Because by the time the price also, if you're looking at price, the price also might have done a little bit of movement to prove to you, saying that, okay, it has broken the previous low or whatever. But then that is definitely one, thing that you will have to keep in mind when you're looking at markers. The markers are good. They're pretty good. There's one strategy that a lot of people follow is markers along with opening range, and that you can see it right away. In the morning, what many people do is, there are people in Discord, they post it as well. At the top, so they try to take call buy here and put buy here in the morning hours. Call buy at opening range high, put buy at opening range low. Morning hours, like I said. For call buy at opening range high, they need blue markers, and the price has to break the opening range, and they need blue markers. For example, today morning they had blue markers, but the price did not break it, and then it immediately came back. At the bottom, they need pink markers. Although price broke the low, there were no pink markers, so they will not take a position. Once it comes here, now they have a confidence. So it is trying to break the opening range high. It broke the high. They will try to take a position. Ideally, they will try to go to the next strike. Next strike is 2650. And then, the idea is to trail it to see if it can go to 26100. If it doesn't, trail it with the largest candle's bottom so that you don't miss out the trend at least, or whatever is the trailing mechanism. Believe me, I'll give you much better trailing mechanism in just a while. But then this is one strategy that a lot of people follow. Another thing, it again broke out, and then again another trade to 20-30 points, probably another trade basically comes from here. But then again, this I'm saying probably is a potential opportunity, because there is no pink marker. Pink is missing. That is equally important, and blue markers are continuing. Blue markers never gave up, and there is absence of pink, which is even more important. If I had one or two pink in between also, I wouldn't be as confident, right? Pink is completely missing. Blue is continuing, gives me confidence that probably I can take one more from open range high to probably again to the next strike. So at the bottom, you need pink markers. At the top, you need blue markers. Now, there is a lot of people who have done backtesting of this, and the kind of results that people have done, I recommend you do the backtesting as well. Whatever ideas we are sharing you today, the important thing is we want you to consider it as ideas, and then we need you to evaluate them yourself. Please go and evaluate these ideas and see if it is making sense to you. Only then we need you to be confident about it. Don't go by what I am saying. Verify it for yourself. That is critical. Very, very important. The backtesting results that most people posted, they don't get more than 30-32 trades per month, which is great because the number of trades are very less, and their profitable trade percentage is more than 55. The least I saw was 55%, and 45% obviously loss making. But then if they see the ratio of profit making versus loss making, the profit making ratio, the minimum that I have seen from the backtesting results that people have shared with me is 2.5. That means if you lose 1 rupee, you are making about 2.5 rupees for every profitable trade. That itself should give you a confidence to evaluate this idea yourself, to see, if you can get similar results and if this works for you. Because more than 55% is profitable trades. You have got 1:2.5 is the loss versus profit making ratio. What else do you need? That seems like a very good strategy to begin with, right? So again, morning hours, only opening range, I call buy here and put buy here. Eventually, if the price is coming down, then you look at taking, if it breaks and goes down, then you try to take a put buy from here, provided it breaks and has continuous pink markers. Then you are looking to take a put from here. If the strike is too close, go to the opening range or to the next strike if it is at least 30 points. That's how we say. But then of course you can modify the strategy according to your own thinking and your own comfort. Okay, I hope you understood the opening range strategy that I've explained to you. There is one more thing that I need to explain. The markers themselves are pretty good. Whether you want to trade from the strike to strike, or you want to trade from opening ranges, either ways, they're pretty good. I would only recommend you to go into historical data and check for yourself. Beyond that, there is something else, and which is even more powerful. But before I go there, I would like to also tell you, saying, if you're looking at strike-wise volume, this chart will only show you the latest minute data. That means if you're looking at 330, this is 330 or 329, 328, whatever, the last minute's data. You don't know what happened to 26,000 since morning. We only know that it is 1.9 million now. But what was it since the day morning? That we don't know. To see that, you can click on it. When you click, this chart opens up. If I take out Alpha Arc, This is exactly how it has proceeded. Morning 26,000 actually calls were stronger, but puts continuously built their positions. Calls gave up. Put continued to build their positions. Calls completely gave up. And then at the end, puts also slowly gave up. Okay, at 26,000. That's how we read this data. Now, alpha arc, like I told you, is nothing but a smoothed line. It just gives you a better reading of the data, better look of the data. Instead of too many zigzags, you can know that, okay, puts were building very, very strong. At one point they gave up and they basically given up or exited their contracts. Along with it, if you look all of them, there is an option called as show candles. All that it does is the same thing, that line, it converts it into candles and it shows you into green and red candles. Simple. I will talk about it in little more details in just a little while. Same thing, candles, the data every minute that you see, it converts it into candle. There is a smoothed line anyways that you will be able to see the candles also. And in this pop-up, you also see call and put price for that particular strike. In the same window, you can see call and put price. But then it is very difficult to click on it every minute and see how it is developing minute by minute, which is why we have got something called as strike wise seller, and we have another option called as strike wise data. If you click on it, it opens a screen. I'll reduce this. It opens a screen where it is showing you the same thing that you have seen earlier without call and put price. You don't have call and put price here. Let me enlarge it, make it big. This is 26,050, not 26,000, 26,050, but essentially the same thing that you have seen before. Call and put, same thing, but for 26,050 strike. Okay. If you don't want to see candles, you can see just the lines. Alpha arc you don't want, you can remove it. If you want alpha arc, you can keep it. Everything is the same. You can see height of it, whether you want how many pixels you want, you can decide. Okay. At the same time, you can see just the ATM strike, or you can see 3 strikes. That means ATM, ATM +1 and ATM -1. If you see this in the daytime, it will automatically change ATM +1 -1 based on how price is moving. You don't have to do anything. ATM strike changes, +1 changes, -1 changes. You can analyze all of this in one single screen without clicking anything. This will keep changing. You want +1 or you want more. For example, +2, -2. ATM, you have got +3 at the top and -3 at the bottom. How many strikes you want to see at a time, that is completely up to you. You can choose that and you can basically decide whether you want to see 3 strikes, 7 strikes, or you want to see only 1 strike. Number of strikes and height of the chart. Okay, I would just stick to 1 for time being, and I'll increase the height because it becomes easy to explain. You have one more thing here. If you don't want to see call and put separately, you can just say show this, show strike trend. We are going to rename this to PCR, put call line or something like that. This combines calls and puts into a single line. Now, at each strike, you know when it is pink, you know that there is a sell pressure increasing at that particular strike. The moment it becomes blue, you know that there is a buy pressure increasing in that particular strike. And then pink again, sell pressure is increasing at that particular strike. Very simple. Blue candles above, that means that particular strike puts are very, very confident. Pink candles down, that means calls are very, very confident at that strike. The same thing, I'll remove the candles. If I'm looking at 3 strikes, I'll remove this. At the daytime when you are looking at it, imagine how easy it becomes for you to understand the direction. In the daytime when you are looking at it, you will see ATM strike. You will see ATM +1, -1. Assume that -1 is always blue because from bottom you will obviously have puts very strong. Buy pressure is more from the bottom. You will see blue. But then ATM is pink. Above ATM is very, very pink. What does that tell you? It tells you that at the moment, currently, sell pressure is prevalent. Doesn't look like price is going to go up. For the price to go up, below the ATM, yes, obviously it has to be blue, but at least ATM has to be blue. And then the pink at the top, if it slows down a little bit, if the curve is not like this, but if it is at least slowing down, even better, because this is blue, this is blue, this is slowing down. Now it is time to go, probably for the price to go up. Look at this line in the data. If you are looking at it from historical data point of view, it makes even more sense. I'll just show the same thing to you. Okay, let's see historical data. Today's data I'll open. And then I'll go to strike. It is not showing you anything because 339 there is no data. If you go to 328, you will see the data. Please don't get confused saying there is missing data. In the historical data, you will be able to see at each minute how this looked. But if you looked at strike-wise data, and then here now in the historical data point of view, we will be able to select the time. At 10:09, I want to change show strike trend. I want to remove candles. Chances of Nifty going up is very high. Why? Although there is pink at the top, obviously sell pressure has to be there. It is not falling as, for example, it was falling falling here. It is still negative, it is still going negative, but then this has become positive already. For some time now this has become green. This is obviously growing very, very fast. This is growing faster than this is falling. This is blue already. So I would like to believe that these two will push it together and will try to push the price up. Simple as that. If you are looking at this trend line, it becomes easy to understand the direction of the market just by looking at this. 3 strikes are important. And let me also tell you, if you are trading in the market, the most important question that all of us should be asking is, will Nifty go 50 above or 50 below? That is the most correct question to be asked for any trader. Will Nifty go 50 points up or 50 points down? The reason is, all institutions and retailers, we only have the capability to invest in strikes at the multiples of 50. So everybody's interest is to either push the price 50 up or 50 down. Now, when you want to ask that question whether Nifty will go 50 up or 50 down, this chart becomes very easy. It tells you that at this moment looks like Nifty will only go 50 up. Chances of Nifty going down at this moment is very less. That question, you would be able to get an answer very easily when you are looking at this chart. No call, no put. Just look at them as one PCR lines at each strike and you will understand that the current pressure is essentially dictating that the price will go up. Or rather, Nifty should go up 50 points, it should go up. Hope you understood. You can visit the chart either from historical data by clicking on this. If you go from historical data, you would be able to select the time, but you can do it from live data also. When you do live data, the ATM strike changes automatically. You don't have to do anything. You can decide whether you want to see 3 strikes, 7 strikes or 1 strike. And then you can decide whether you want to see call put or you want to see just a PCR line. All that option is available to you. Beyond that, you also have an option to see strike view. Now, this is another option, strike view. The reason you have strike view is Nifty, I want to only see 1 strike. I don't want to see more than 1 strike. And I'll tell you why you may want to see a single strike. For example, 26,000. I want to see only 26,000 to begin with in the morning because the price was around that. If price moving up, you can select more strikes. 2650, I want to add 26,100 and maybe 1 or 2 strikes at the bottom. I'm just adding them. Nothing is happening. They're getting added here. And then I'll click on this. They are available for me to click on them easily, more than anything else. The advantage in this is this particular strike will not change. Unless you click on the strike, you will continue to see 26,000. It will not change automatically. You have to manually click. How do you know ATM has changed? It will tell you here. ATM strike is moving and this will work for all indexes. Nifty, Bank Nifty, Sensex, everything, it will work the same way. ATM changing, you will know from here and then you can click and you can change it. Unless you click on a different strike, the data will not change. It will show you live data for 26,000 every minute without changing that strike. You will also get the 1 minute price of call and put in the same screen live. Every minute this will automatically refresh. It will bring you the volume and the price automatically. So this is just another way for you to see the data. Why this data might be important, I will tell you. Let's say that in the morning we don't do, and this is very, very important strategy, that morning, let's say first half an hour to 45 minutes we don't do anything. Price is around 26,000. Now when the price was around 26,000 at 9:50, 10 o'clock, around 26,000, I don't know whether to take call or put. Let's solve that problem using volume candles and using sell volume. What I will do in the morning is I'll see 26,000 and then I'll show candles. Let's remove calls. Let me explain this a little more. As an option buyer, will you buy or not? And as an option seller, will you sell or not? Let's answer both the questions. Now, like I said, when you look at I'll remove this for just a while. These two lines, what you're seeing is seller volumes. The blue is put sellers. The red is call sellers. Call sell and put sell. You will see it here, the colors, and you will be able to filter them out. Call sell and put sell. Now, if I ask you, when the sellers are increasing, this line is increasing. As an option buyer, do you think you have chance of making money when the line is increasing or when the line is falling? I'll rephrase the question and ask you again. 26,000 put. If you want to buy 26,000 put, what are your chances of making money when you invest it while this line is rising or while this line is falling? Would you buy 26,000 put before 130 or 145 or after 145? Which is best as an option buyer? When sell volume is increasing, that means supply is there. When supply is there, why do you want to buy? Correct. Morning time, I told you we had a dilemma whether to go for put or not. Now I will ask you, I have volume candles and I have got put line. Would you buy put today? 26,000 put, even at 940, 945, maybe you would probably take an attempt and you will exit. I would tell you how to avoid that also. But then would any of you do 26,000 put, for example, today? Till 145, would any of you really do 26,000 put at all if you were in the market? None of you would buy 26,000 put. Rather, none of you would buy put at all today. You would never buy put. If you were to buy put, probably when consolidation happened, maybe this was an area, but you would exit immediately. I will tell you how you would exit immediately. This is one powerful system where you would be able to understand whether you should buy or not, when you should buy, what should be your stop loss, what should be your trailing stop loss, everything you will understand in the same system. Till about 1:45, 2 o'clock, you will never buy put. Easy. Today there was no chance of buying you put. Would we have lost? You see, put have essentially till 1:45 has only lost money. Was easy? It only made money after 1:45. But till then, it only lost money. Correct? Okay, this was a put story. Now let's look at call. Again, the question is the same thing. We need liquidity disappear. We need sellers running away. Only then as an option buyer, we can buy. As an option seller, we need sellers come back and be very, very powerful. Only then we will sell. I will talk about that also in just a while. Bear a note, a disclaimer. Volume candles are not very good in the morning till about 9:30, 9:40. So morning hours, please ignore it. Let them form. Let them take time. Only after that. You may miss a move in the morning. Unfortunately, can't help it. Because volume candles, since they are forming in the morning time, it's very difficult to understand. Unless you are used to seeing the candles for a good amount of time, you wouldn't be able to make sense of it. So safest thing is ignore them till about 9:30, 9:45. Beyond that, let's see. One big red candle, that is all I'm looking at. But that red candle, I want it close to this line. If it is far from it, it went too far from the line and then there is a red candle. I want another big red candle close to this line. It doesn't have to be below this line. It doesn't have to close below it. I just need a big red candle and I'll show you some examples. Big red candle, good. I'm confident that sellers are exiting. I'll take a position. Now, my stop loss is top of this candle. But if this candle is way too big, sometimes you will get a candle which is way too big. If the candle is way too big, take it as 75% of this and say that 75% of this is my stop loss. If it goes beyond that, I'm out, I'm exiting. So let's hope that this candle is not too big for you. How big is too big? You can only answer it for yourself. Even if I tell you, you will not understand it. See historical data on what kind of trades you would have taken. You will yourself understand how big is too big for you. Even if I tell you, you will not understand it. You will need to spend that time in the platform. Historical data is free. Sit and look at different candles. You will understand, you yourself will understand what is the risk that you want to take depending on the candle size. But I am saying 75%, I would probably hold it a little more because as it went up, the candles were smaller and smaller. One more candle, if it had gone, probably I would have exited. But let's assume that we would not have exited. 10-12, we have taken an entry. You are expecting one big red candle. Another big red candle came. This candle's top becomes your trailing stop loss. Another big red candle, top of that is your trailing stop loss. Top of this is your trailing stop loss. Top of this is your trailing stop loss. And then obviously it hit slowly. It is going up somewhere at about 10:42, 10:43, 10:44. We'll say, okay, we are done. We will exit. Your entry came at 10:12. You are exiting at about 10:42, 10:43. Let's say. When was your entry? 10:12 and 10:42, 10:43. Okay. Where is 10:12? 10:12 is 187. 10-12 is here, still at the bottom. Most of the times you would get it rock bottom. You will be able to capture entries literally at the bottom and I'll show you. You see it for yourself. This is still a good place. 10-12 is your entry. When was the exit? 10-12, you got it at 196, 42, 226, 230, somewhere in that range. Probably you would have exited. Because end of this candle you wanted to exit. So somewhere here, 2-3 candles, wherever you wanted to exit. 220, 230, you could have exited. Although prices were kind of little on a higher side, you still made a decent margin for that day. Now, how did you take your entry? Candles told you. How did you continue to trail? Candles told you. Could we have done that same thing again? Let's look at it. Another candle. Yes, big red candle. This could also you would have taken, but let's say that you would have taken this. If you had taken this, well and good. If not this, another red candle. Another red candle. It hit. So you would take an entry at about 1204. You would exit at 1214. 1204, 1214, right? Let's see what happened. 1204, how much you got it for? 223, 226, 2-3 rupees profit only. Even though the candles were not in your favor really, but you still made 2-3 rupees profit. Good. Apply the same thing here. Big red candle to trailing stop loss mode. Since this is too big a candle, I would actually go for half. See, this is too big. I wouldn't even go for 75%. Even half of it I am done. Then there are two big red candles. Probably I would consider them as single candle and I will say this stage I would say I'm done with this trade. I'm not looking at the price. You know yourself that if the candles have fallen from here to here, you're already in profit. You can evaluate it yourself. Then what happens is you would get a lot of small candles. Wait for big candle. Don't rush. And after 3 o'clock, I wouldn't anyways recommend anybody to take any trades. Small candles, ignore them. Wait for one big red candle. Now you know there is something to compare. Have a candle that is at least this big, at least that big. If you are able to see a candle that is as big as this, maybe you would still take a trade. If you don't have big candles, ignore them. Maybe you would take another trade, but your stop loss is only going to be 2-3 rupees or 4 rupees, not more than that. Even if you take a trade, your stop loss is not going to be more than 3-4 rupees because the candles is immediately broken. The highs are broken, so you would immediately exit. The point is, this is a system that is telling you when sellers are exiting. Your entries are exactly when sellers are exiting. What else do you want as a trader, as an option buyer? And then the system is also giving you stop loss and trailing stop loss. Now, in this case, for example, in the morning case, you had taken your entry somewhere here, let's say, or somewhere here, I think, and you exited here right before the price went sideways or right before the price kind of went down. You entered at the bottom and you exited at the top. This will become even more visible to you if you look at some other data, slightly different data. I hope you understood. What can a seller do? Let's look at it put. If the candles, let them come down. If they come below the line, even better. If they don't, as soon as you see the red candles, if you don't want to take a trade in the morning, as soon as you see red candles, if they break that high, it is probably your opportunity to sell and continue to sell till they consolidate or till you see a big red candle. Maybe it is time to adjust or exit and take a trade only when you have got another higher high broken and then continue again till they consolidate or they exit. Once they are below this, as a seller, you are not even interested. As a buyer, you are interested as soon as they start coming down. Tell me if trading can get easier than this, right? Let's look at one more data. Okay, I would like to go one more day. Let's look at yesterday's data. It's very interesting when you look at it, yesterday's data's point of view. I'll enable the markers also just for you to see markers, right? Price in the morning went from 26,000 to 26,050. It was in the range, in the 26,000 to 2650. Now, we knew, whoever is using the platform, they knew that 26,000, 2650, 26,100 is kind of a seller zone. We had a resistance zone here. We had a support zone in 900, 850, 900. We had support zone. This was our resistance zone. I will tell you how I am saying this is resistance and support zone later. Now, I am looking to take a put trade from the top, somewhere here. Since the price is at 26,000 and it is going to 2650, I could either look at 2650 or 26,000. Let's say we look at 2650 because reversals will come from the strike at the top. Reversals upwards will come from strike at the bottom. So 800, for example, if the price came here, 850 was the right strike. Since it came to 850, 800 is the right strike to tell you that reversal will come. Okay. Again, it is very easy to understand. When you look at these three strikes, the first guy who will remain blue is the guy at the bottom. The guy at the bottom will become blue first before even these two turn. This is the guy who will become blue first. So if a reversal were to come right below the ATM, that is the guy who will tell you first, he will give the indication that reversal is coming. If a reversal is coming from the top, rather bottom, if the market is going up and if it were to go down, above the ATM is where you will get the first indication of the reversal. Going by that knowledge, 26,050 expecting a reversal. So 26,050, let's say we are looking at this data. Now let's understand. I'm interested in put in the morning, right? Because I want to take a put trade. I'll remove call. Let's look at in the morning. I've got one big red candle, second big red candle, it has broken the low and it has become, and it is also close to this line. I have my entry at 950 for put. Same thing we will apply. Stop loss is about top of this. Trailing stop loss is here. Not too big, but maybe if I want to trail close, maybe this is still, I would rather want a slightly bigger, but this is also fine. Combining these two candles, this is my trailing stop loss. The moment, since this has broken, this big green candle came, I'm done. Even if the market goes further down, I'm not interested. I'm done with my trade. Our entry was somewhere at about 950. Our exit is about 1014. 950, 1040. Put. Now, at the bottom, nothing in the market could tell you that, at the bottom, you could have probably, taken a buy trade. No other system can this confidently tell you that you could have taken a buy trade. And then look at where you're exiting. 1014, 152. Where did we get? 950, 73, 1014, sorry, 150, 160, whatever. 155, 160. That is the range we would have exited. Beyond that, there was no big move. If there was a big move, the candles would have continued to fall. Red candles would continue to fall. You would not have a consolidation. You would not have big green candle, right? They would continue to fall. The move was more or less done. That is why you had a green candle coming and breaking the high. Imagine how easy, it was to capture that. Done. Fair enough. We have got a put entry, but that's not about it, right? We'll have to see in the entire day, if we could take other trades, right? Now, since we are looking at reversals, like I said, this was support zone 900. When it came to 850, I could have probably taken it 850, or I could have taken it probably 800. Let's look at 850. What did 850 do? What are we looking at? We are looking at call buy, right? So when price comes to 900, I'm looking at 850. I'm only interested in call. I'll remove put. I'm only interested in call. Now, there was one big red candle here. I could have taken that trade, but then we could have continued. I would have probably exited. Since it has tried to broken and go back, I would have definitely exited here. An entry here is obviously is possible. 11.25. I'm exiting at 11.55 for call. That would have probably become a loss. Let me show you the loss making also. 25, 79, 55, 64. I think 10 rupees to 11 rupees kind of a loss. This is big. You wouldn't get this big losses in most of the times because it has taken a lot of time and then nothing came below this candle. So obviously that kind of burned a lot of money. But then if you could see that the candles are not going below, if there is a way you could mitigate it, if you see these candles day in and day out, you will come up with better solutions. Then you have another entry. This is a big red candle. You would go for the top or even 80% of this is still fine. I will not go to the price to tell you that you would have made a massive profit in this from 12.24 to about 138 or 140. This was expiry. Nobody needs to tell you that you would have probably made 100% returns on your capital in this trade. Continue with that. Another big red candle. At the end of the day, you probably had another opportunity, 256, but I'm not sure if you're a guy who would be willing to take trades at the end of the day. However, that there was an opportunity. When price came again at 900, 950, 900, again, I'm looking at put entries, right? 950, same thing you do. All that you're doing is while price is going up, can you see a put opportunity? This candle, loss making, obviously it would end up being losses. This also would end up in loss. Then you have got continuously falling. You would take an entry here and that would end up giving you a good profit. You will have loss making trades. I'm not telling you this is a system that would not make losses at all. And I'm deliberately showing the price, how much loss you would have made. Here, I am sure you would not have made more than 4-5 rupees. Same thing here, 4-5 rupees, 2-3 rupees, not more than that. Sometimes even you would end up exiting at cost. But then because since it moved immediately, your loss would not be much. But here you would end up making significant amount of profits in this particular trade. Volume candles are extremely powerful. They are very, very powerful. I don't want any of you to go by what I am saying, right? I want you people to go to the platform, see historical data, see your historical trades, see if you were to believe volume candles, how would they have helped you? I would also advise you to look at on sideways market. They'll help you significantly even in the sideways market, because in a sideways market, when price is not going up for both call or put, the volume candles are above the smoothed line for both call and put, and they both are growing. They both are significantly increasing their price. Only then the market is sideways, right? Both call is selling aggressively, put is selling aggressively. None of them will present a buy opportunity. The buy opportunity will be presented as soon as one of them give up. What more do you want? Even in a sideways market, they are not giving you a buy opportunity because they both are growing. They both are significantly increasing their positions. I would request you to go and see the data for yourself, because there are many scenarios that I would not have covered. No way I could have covered every single scenario. I would invite you to go and see those scenarios, try different scenarios for yourself. I believe you understood the base concept. You can apply that to evaluate it and see for yourself.